Ladies and gentlemen, today the mid-market exchange rate tells a story of both stability and uncertainty. One US dollar holding firm at 1,310 Iraqi dinars. At first glance, this figure may appear calm, steady, even reassuring. But beneath the surface, this number represents the intersection of government policy, oil revenues, regional trade pressures, and the daily struggles of Iraq's people. It is not simply a rate on paper, it is the pulse of an economy, the measure by which livelihoods rise or fall. The phrase mid-market is key here. It reflects the average between the buy and sell prices in the foreign exchange market, a benchmark often used to judge currency strength. For Iraq, maintaining this mid-market line at 1,310 is no small task. The Central Bank of Iraq is working tirelessly to prevent volatility, using its dollar reserves to defend the dinar and to reassure markets that the national currency is still strong. Yet in the background, traders, importers, and everyday citizens remain watchful, because they know how quickly calm can turn to turbulence. This steadiness at 1,310 is more than a technical achievement. It is a political signal. It tells the world that Iraq's economy, despite its heavy reliance on oil and its exposure to global shocks, is determined to project resilience. Investors read this rate as a sign that the government is serious about stabilizing its financial system. Households interpret it as an indication that their wages, their savings, and their purchasing power are not under immediate threat. But maintaining this balance is like holding a fragile vase. One wrong move, one unexpected shock, and the cracks begin to show. To understand why 1,310 matters so much, we need to step into the daily lives of Iraqis. Imagine a family in Baghdad. The father receives his monthly salary in dinars. The mother heads to the market where nearly every good rice, sugar, cooking oil, medicine, electronics depends on imports purchased with dollars. If the dinar weakens even slightly, prices rise. Bread that cost 500 dinars yesterday might cost 600 today. Gasoline for the family's car might jump unexpectedly. Rent, often tied indirectly to the dollar, creeps higher. That one number, 1,310, determines whether the family feels secure or anxious, whether they plan for tomorrow or simply survive today. But while the official mid-market rate sits calmly at 1,310, not every Iraqi experiences that number equally. In Baghdad's official banks and exchange houses, yes, the dinar holds steady. Yet in Erbil, in Basra, in the informal black markets of Mosul and Najaf, whispers of slightly higher dollar prices circulate. Parallel market rates sometimes diverge from the official mid-market line. For traders, the real price of the dollar is often what they can get in the street, not what the central bank declares on paper. This divergence is small for now, but even a gap of 10 or 20 dinars can sow doubt, and doubt is dangerous. Behind this balancing act lies the power of oil. Iraq earns the majority of its foreign currency from crude exports, sold on international markets in US dollars. When oil prices are high, Iraq's dollar reserves grow, giving the central bank strength to defend the dinar. When oil prices fall, the opposite happens. Reserves thin, pressure mounts, and the exchange rate trembles. At 1,310 today, the message is that reserves are strong enough to back the currency. But every Iraqi knows that this balance is fragile, tied to the whims of global markets and the decisions of faraway powers. The stability at 1,310 also reflects a tug-of-war between reform and reality. The government has pledged to modernize Iraq's financial system, expand digital payments, and reduce dependence on cash. Such reforms, if successful, could shrink the power of the black market and strengthen the dinar. But change is slow, and corruption, smuggling, and inefficiency remain stubborn obstacles. For now, the dinar holds its ground, but many ask, for how long? The steadiness of the dinar at 1,310 may sound simple, but in reality it is the outcome of a complex, ongoing struggle. It is not only a number written on a central bank board. It is the result of interventions, policy maneuvers, and a network of actors inside and outside Iraq that shape its fate. To understand what this rate truly means, we must dig into history, look at the black market realities, compare Iraq with its neighbors, and explore the risks that could unsettle the calm. For decades, the Iraqi dinar has been a symbol of volatility. From the sanctions era of the 1990s, when the dinar collapsed in value, to the chaotic years after 2003, when US dollars flooded the economy, Iraq has struggled to keep its currency trusted and stable. People remember vividly when the exchange rate would shift not over years, but over weeks or even days. Salaries lost their worth overnight, and families who thought they had savings watched them evaporate. Against that backdrop, today's relative stability around 1,310 is more than a technical success. It is a psychological achievement. It creates the perception that the economy is finally under control, that Iraq is not spiraling into another financial freefall. But while the central bank presents this stability proudly, the street tells a more complicated story. In Baghdad, a shopper might find that the official mid-market rate of 1,310 doesn't fully translate into what they pay at the exchange counters. Instead, some traders demand a few dinars more per dollar, citing higher demand or limited supply. In Erbil, the dynamic is slightly different. A strong demand for US dollars to pay for trade with Turkey and Iran often pushes exchange houses to charge above the official line. These differences may look minor, sometimes only 10 or 20 dinars per dollar, but they add up. For importers buying large shipments, the difference means thousands of dollars in added cost. For ordinary citizens, the perception that the black market is more real than the official rate creates doubt about the government's credibility. And that doubt is dangerous. Currency is built on trust, and when people stop believing in the official number, they begin hedging in dollars. This behavior fuels a vicious cycle. The more Iraqis hoard dollars to protect themselves, the more pressure builds on the dinar. That is why the central bank has taken measures to flood the market with controlled dollar sales, using its oil-based reserves to keep supply steady. By doing so, it seeks to reassure citizens that 1,310 is not just an artificial figure. It is the true, defendable value of the dinar. Yet every action has a cost. Selling dollars to defend the dinar reduces Iraq's reserves over time. If oil revenues were to suddenly fall, that defense would weaken. Already, many analysts quietly question whether Iraq can maintain this rate if crude prices decline sharply or if global demand contracts. The truth is that Iraq's currency is still heavily tied to the fate of oil. Unlike more diversified economies, Iraq cannot easily offset oil shocks with manufacturing or service exports. For now, oil revenues are strong, but history teaches that the market can turn quickly. Meanwhile, inflation remains a lurking threat. At 1,310, inflationary pressure is being contained, but if the dollar were to rise even slightly, imported goods would become more expensive. Iraq imports a significant portion of its food, consumer products, and even basic medicines. The link is direct. Every increase in the dollar translates into higher costs on store shelves. For a wealthy importer or businessman, this may be a manageable adjustment. But for families earning fixed salaries in dinars, a sudden price rise can be devastating. It is no surprise, then, that street protests have often followed spikes in the exchange rate. People feel the shift almost immediately in their daily lives. This tension between official stability and unofficial strain is not unique to Iraq. Across the region, countries face similar battles. In Lebanon, for example, the official exchange rate is often little more than a formality, with the black market dictating real value. In Turkey, rapid inflation has eroded the lira, showing how quickly confidence can collapse. Iraq is determined not to follow these paths, which is why it clings so tightly to 1,310 as its anchor. Still, the comparison reminds everyone how fragile the situation is. Looking forward, many observers ask whether Iraq is preparing for something bigger, a revaluation of the dinar or a more comprehensive monetary reform. Such speculation grows whenever the central bank makes moves to adjust cash supply or tighten regulations on dollar usage. While officials rarely speak openly about revaluation, the very fact that Iraq has the reserves and the oil revenues to back its currency sparks debate. Could Iraq someday surprise the markets with a stronger dinar? Or will the black market pressures continue to hold it down? What is clear is that Iraq is not acting in isolation. U.S. policy plays a significant role. Restrictions on dollar transfers, compliance with international banking rules, and oversight of transactions with neighboring countries all shape how easily Iraq can defend its rate. Washington's decisions about interest rates, sanctions, and oil markets ripple directly into Baghdad's currency policy. Every meeting between Iraqi and U.S. officials carries hidden weight for the dinar. At the same time, Iraq's internal reforms matter. The expansion of digital payments, attempts to reduce cash transactions, and moves to integrate more of the economy into the formal banking system are steps designed to reduce dependence on dollars. If successful, these reforms could weaken the black market's influence and strengthen confidence in the dinar. But reform is slow, often meeting resistance from entrenched interests who profit from the current system. So when we look at the rate of 1,310 today, we see not just stability but a delicate balance. It is the outcome of oil revenues flowing, of dollar reserves being carefully managed, of international pressures being navigated, and of citizens cautiously watching every change in price. It is a victory for now, but a fragile one, and every Iraqi knows how quickly the winds can change. For the family in Baghdad buying bread and fuel, the number 1,310 is not abstract, it is survival. For the trader in Erbil sending money across the border, it is the line between profit and loss. For the policymaker in the central bank, it is the proof that their strategies are working, at least for today. And for the investor abroad, it is a signal of whether Iraq is a place of opportunity or of risk. The question remains, can Iraq hold this line? Or will bigger moves come, driven by forces beyond its control? The answer will shape not just markets, but the daily lives of millions. The story of 1,310 is far from over. It is being written every day in the shops, the exchanges, and the households of Iraq.